So I want to get a little more specific now. So how can you show that declining demand for workers is actually a cause of the low employment to population ratio we see in the US right now? Well, we're going to do two things. First, I'm going to make it very specific, and I'm going to link it to one important sector, and I'm going to show you this sector is very important for certain types of workers, and that's going to be manufacturing. And then the second thing I'm going to show you is because there's regional variation and to the extent to which manufacturing is important in the US, do we see different patterns in the employment to population ratio and wages for places that were very manufacturing intensive 20 years ago relative to places that aren't manufacturing intensive. So that's what our goal is in the next few minutes. So let's just start with the raw data. You guys could download all this yourself. It's just from the US government. It's total manufacturing employment in the US. Back in 1980, those years right there are every decade. So 1980, 1990, 2000, 2010, I'm just putting things in roughly 10-year chunks. Back in 1980, there was about 18 million manufacturing workers in the US at that time. Between 1980 and 1990, we lost about 1.7 million manufacturing workers. Anybody ever seen a Michael Moore movie from the mid-1990s? This is what he was talking about. Okay? Basically, the decline in manufacturing in Detroit that occurred during the 1980s was kind of the focus of that movie. I believe it was Roger and Me. Okay? 1990 to 2000, we lost another 0.3 million manufacturing jobs. So 2 million manufacturing jobs were lost from 1980 to 2000. Now I want you to look from 2000 to 2010. We lost 6 million manufacturing jobs in the US over that short time period, which many of them were lost, about half of that 6 million, about 3 of the 6 million, were lost before the start of the Great Recession. When you talk about the revival in US manufacturing, in employment space, we've added about 0.4 million manufacturing jobs since the depths of the Great Recession. It is tiny relative to the manufacturing jobs that we've lost. So why is US manufacturing falling in employment space during this time period? Well, there's two prominent stories. One is that trade competition from the rest of the world was depressing US manufacturing. But in order to talk about that trade story, I want to show you data in employment space, in output space. So what in this picture is how much has US manufacturing output increased. And you can see manufacturing output increased by about 25% through the 80s, about 60% during the 1990s, and increased by about 10% from 2000 to 2010. So despite the fact that there was 6 million less manufacturing workers during this period, we were still producing 10% more manufacturing output than we did the decade before. So it's not completely a trade story for the reason for which manufacturing employment fell. Because trade stories would say we just don't produce manufacturing goods, and the workers and the output have gotten exported to other places. One component, I'm going to show you this though, that is consistent with this patterns is automation. That technology has changed in the manufacturing sector such that they could produce more output with less workers than they did before. And just in the back of your mind, this is how manufacturing output has changed from, this time I labeled from 2007 on. It has not changed since 2007. It's increased from the depths of the Great Recession. But you can see the most recent data. This again from a month or so ago when they've started talking about a recession in manufacturing. You can see manufacturing output is starting to turn down a little bit in recent periods. But again, that is tiny relative to the time series trends that we've seen over the last 20 years in the US from 2000 to 2010. Okay, I've already told this, I've already told you all of this. So how do I show you data that U.S. manufacturing technology has changed in a way that displaces workers? Okay, what I'm showing you here is a fancy thing that we do in most of our economic models where we measure things in labor share space. Okay, what is a labor share? Labor share is how much is the labor bill of a firm relative to the output of the firm during this period. So how much of your sales goes to workers versus machines or the owners of capital. So there's three ways your money could go to. It could go to the workers, it could go to the people who give you the machines, or it could give you to the owners of the firm, okay, in dividends and profits and things of that nature. What I'm showing you here is the labor share in manufacturing relative to all other sectors, including of manufacturing. And the labor share is measured in index form. Okay, it's basically now the way we do it is just in percentage changes over time, and I've anchored the index such that it is equal to 1 in 1987. Why? So I could just show you that between 1987, that's when the data starts, and consistently measured industry codes in our new industry coding system, 1987, that is basically roughly constant from 87 to 2000. It's declined a little. But from 2000 on, particularly prior to the Great Recession, look at the fall in the labor share in the U.S. manufacturing sector. Firms are selling stuff, and it's just going less and less to workers. And if I had the flip of this, how much of it is going to capital, the machines, it has been going up through this time. And the way that we interpret that, it is the only explanation, is that manufacturers are producing much more of their output with machine technology as opposed to worker technology during this time period. Let me show you one last thing about how important manufacturing was historically for low-skilled workers. So what I'm showing you here is historical data on the share of men 21 to 55, again another prime age definition, that allocated their labor to the manufacturing sector. So the denominator is all men 21 to 55, whether you're working or not. The numerator is how many is working in the manufacturing sector. And historically, for men with education of a high school level, basically just under a third of them, 30% of them, worked in the manufacturing sector. This was a hugely important sector for less educated men. Men with some college but not a bachelor's degree is the middle line, and the men with a bachelor's degree or more is going to be the bottom solid line. And what you could see is that manufacturing is becoming more and more education intensive over time. What do I mean by that? The relative propensity for low-skilled men to be in that occupation relative to high-skilled men has been narrowing over time. And so that means the composition of manufacturing going to high-skilled men has been increasing relative to low-skilled men over time. Manufacturing is becoming more skilled intensive. Some of you or your friends might be working as engineers in the manufacturing sector now, making the robots to displace the workers relative to the workers themselves. So not only has manufacturing employment fallen, the composition of employment has been changing to favor the skilled relative to the unskilled. Okay, so that's all background. So how do I know whether the manufacturing decline is contributing to the declining employment rate that we started the beginning of the talk about? Well, to understand that question, I'm going to start exploiting some regional variation. Some places of the U.S. were much more manufacturing intensive in 2000 than other places. So think about Detroit versus Orlando. So Detroit, very manufacturing intensive in its employment mix in 2000. Orlando was very Disneyland intensive in its manufacturing mix in 2000. So one specializes in tourism, the other specializes in manufacturing. To the extent that workers don't move that much, and I'll show you some data on that in a second, they do, but not a huge amount. We might see increasing or decreasing employment to population ratios in Detroit relative to Orlando during this time period. So what this is every one of those little areas is a commuting zone in the United States. These are officially measured census areas. There's about 720 of them in the United States. A commuting zone is where the people in that area mostly work in that area. So think about the Bay Area, okay, or I'm from Chicago, the Chicago metro area. Most people there, including the suburbs, work in the Chicago metro area. And there's 720 of those in the US. What I'm showing is the propensity of workers to work in the manufacturing sector in a heat map sense. The higher the red, the more important manufacturing was in that sector in 2000. And so the red means basically 20 to 33% of all workers, regardless of gender, worked in the manufacturing sectors in those commuting zones in 2000. And you could see places like the Detroits, the Midwest, was highly in manufacturing in 2000 relative to like the Floridas, in the Las Vegases, in the Californias where farming was important, or the Northeast where banking is important. So you have this type of variation spatially in the US. And so what I'm going to show you here is just a simple scatter plot where each one of those circles is a commuting zone. The size of the commuting zone is determined by the size of the circle. Okay, so Chicago is going to be bigger than, Fort Wayne, Indiana, just because it has more people. So those are bigger circles, means bigger areas. And I'm plotting on the x-axis how much manufacturing fell as an importance in that commuting zone between 2000 and the mid-2015s-ish or so. And on the y-axis, I'm showing you what happened to the employment to population ratio of prime age men. A steep negative line means places that had more manufacturing decline had bigger declines in the employment to population ratio. And that's exactly what we're seeing. Manufacturing shrunk a lot in some regions. Those were exactly the same regions of the US that had employment to population ratios fall by a lot during this period. So again, it's not a causal story. In lots of my other work, I do try to tell causal stories linking these two. But your eye should tell you that there's some link between the intensity of manufacturing initially, or the decline in manufacturing between 2000 and 2015, 2018, 2012. It doesn't matter. They're all roughly the same. And how much the labor market is changing. This is the picture for men. You see the same picture for women. Sharp, downward sloping line for women. And the line, I didn't show you in the talk, is much steeper negative for low-skilled men and women than it is for high-skilled men and women. For high-skilled men and women, it's kind of flat. There isn't much decline for the high-skilled men, even in Detroit. But the low-skilled men are declining by a lot in Detroit relative to low-skilled men in Orlando. And so this type of variation shows there's something amiss in the labor market related to this one sector that automated significantly during this time period. Now, it's not the only sector that automated. We could think about, maybe 20 years from now, the trucking sector, driverless cars, Uber drivers, okay? But why do I focus on manufacturing? It is much larger than all those sectors. It had observable automation during this period, and it's highly locally concentrated. To the extent that people don't move that much, it means you get pockets of declining employment activity that are observable in the data. It just speaks out. I'm going to show you two other pictures here. And again, I want you to just remember this map that we had, the places for which manufacturing was the most important in 2000. Picture one is the propensity to vote for Donald Trump relative to trend in the 2016 election. And you could see the places that scream out relative to trend that change the most. Okay? The South always voted Republican. Okay? The East Coast always voted Democrat. The places that switched, that voted for Obama and voted for Kerry and voted for Clinton, switched to Trump. The places that did that most were in the places for which manufacturing declined the most. Saying that there is something about labor market conditions that are showing up in political domains as well. I didn't show it here, but the same exact damn picture shows up for Bernie Sanders relative to Hillary Clinton in the primary, where people are moving to change the status quo. If you thought Clinton was status quo-ish, people are moving to change. The places where Bernie Sanders did the best relative to the general liberalness of the area was in the Midwest. Second, this is at the state level as opposed to the commuting zone level, because I don't have overdose deaths by opioids at the commuting zone level. But I'm showing you now manufacturing change at the state level relative to the change in opioid deaths, overdose deaths per capita on the vertical level. The places where the opioid addiction hit the most are also correlated with the places for which the labor market conditions, particularly the labor market conditions due to automation associated with manufacturing, has declined the most. Again, so you're seeing it in wages, you're seeing it in employment rates, you're seeing it at the ballot box, both for voting for Trump and voting for Bernie Sanders, and you're seeing it showing up in things like opioid deaths. Suicides will be the same type of picture. Like if I did middle-aged white men suicides, which had been rising nationally, those are disproportionately concentrated in the Indianas, West Virginias, Kentuckys, Michigans, Wisconsins of the world relative to trend. Something to ponder about whether we're in historically strong labor markets by all metrics. Okay, this is just summary. So I want to say one thing here, and then I want to go and talk a little bit about a question I get asked a lot, which is, haven't we gone through structural changes before? Why might this time be different or not different? But before that, I think it's worth pausing, and I have a separate line of research, but I want to emphasize it to you, which is the fact that trade policy might have initially, in the early 2000s, China entering the World Trade Organization, might have put downward demand on U.S. manufacturing employment for all manufacturing goods, both in production space and output space. I think that was important. Okay, automation is there, but so was that. But here's the thing. If we start putting barriers back on trade, those manufacturing jobs aren't coming back, despite the fact that manufacturing output might come back, because manufacturers now produce output in a very different way than they did in the 2000s. And when manufacturers faced competitive forces from China in the early 2000s, their response was automation. And so now, even if we thought that, changing our trade policy might help manufacturers, I think that's true. Changing our trade policy won't help manufacturing workers, formerly manufacturing workers, particularly the low-skilled, because manufacturers just don't use low-skilled workers with the same propensity that they did in the past. So sometimes trade policy and employment policies have been intersecting in the public discourse in the last few years or so. Just keep in mind that it might help manufacturing output, but it need not have big effects on manufacturing workers.